I think ABF as a term has kind of come around because when we talk to our clients, they're looking for diversification within a private credit allocation that's been largely focused towards direct lending or commercial real estate debt. So it can be a bit of a catch-all definition, but it really covers, from the client's perspective, a portfolio completion tool away from assets that have had already a lot of capital allocated to them. And then you could break it down into kind of a consumer angle and a non-consumer angle, as Jack mentioned as well, kind of esoteric, idiosyncratic risk that's uncorrelated to broader financial market conditions. It's important to our clients that they are making investments in private credit where you're giving up liquidity, you're basically ceding some of that ability to transact in the markets. That you're being paid for it, right? And so a lot of what we're talking about when we're investing in ABL is looking for, risk-adjusted returns, as Madeline said, but also we're generally looking for investing in asset classes where the compensation that you're receiving from a spread perspective largely is going to comprise of the illiquidity premium that you can capture, as well as some complexity premium, as opposed to taking kind of directional credit risk. And I think that's one of the big misconceptions, and it's why you'll hear a lot thematically over and over again about how IG credit, IG private credit is very important, because this is not always the case where it's always going to be very credit risky instruments. In some cases, in the case of a lot of the consumer related assets, in case of mortgage-backed securities, for example, or mortgage loans, right? These are very well protected assets that will perform well in a wide range of economic scenarios. And so you want to make sure that you're structuring investments, that you're allocating to asset classes that are going to pay you for the risk that you're actually taking and not for the credit risk. There's an outlook or expectation of a little bit of a kind of two-speed economy for the consumer, right? And so when you look at consumers that are backed by, or consumers that are homeowners, there's a lot of resiliency expected to continue there. Edwin highlighted the kind of the net worth gap. I think another thing that's really important to think about is just the amount of home equity that's available in this country, really since COVID. The mortgage market today is about a $13 trillion asset class. The aggregate value of all homes in this country is about $40 to $45 trillion. So there's a tremendous amount of home equity, and that provides you with a lot of security. But that also leaves you with kind of like everyone else. And Edwin, I led the $10,000 kind of like net worth number, which is pretty shocking, I think, as a bifurcation. And so where should you look, or where should you avoid? I think you should look at some risks down in credit in consumer as being places that you should be cautious on. It has to be priced appropriately, of course. But there's two main dynamics to think about. One is we've come out of an environment where post-COVID, even low credit or weaker credit borrowers were given a lot of stimulus that has provided them with the ability to continue to pay debt that otherwise they would not be able to continue to support. That pulled down delinquency rates in things like subprime auto and other sectors to levels that are very low. And so if you look at those levels rising, they're probably rising at or through kind of the pre-COVID levels today, but it doesn't mean that's where they're gonna rest. They can continue to go higher. The other thing that I think's somewhat interesting as an implication for things you should be careful about in the markets, I think Matt alluded to as well as FICO scores. The kind of long-term impact of COVID era policies is that FICO scores have been effectively inflated, right? If you were a 620 FICO score borrower, pre-COVID, all your debt was either paid for by the government or was postponed and kind of deferred. There was even policies that were implemented during COVID that didn't allow servicers of consumer debt to report delinquencies to the credit rating agencies. Right, that's kind of moved or kind of created kind of a rights shift in the aggregate FICO of the aggregate consumer. It used to be the case that credit scores in this country were kind of normally distributed around a kind of 680 FICO. Today it's probably closer to 720 or 730. When we look at investing in mortgages, for example, right? We look at like the non-qualified mortgage market. When we were buying loans at PIMCO, 10 years ago, we were lending to borrowers with a 680 FICO score. Today, it's probably more like a 735 FICO score. I don't think the borrowers have gotten that much better, right? It's the same borrowers, everyone's kind of moved up in credit because the economy's been so robust for a long period of time. And anyone that did go delinquent, you kind of didn't really know about it. So again, it kind of all goes into like the depth of analysis that you need to do to really kind of weed through a tremendous amount of data that makes up these markets. I think a lot of the principles that we highlighted, or that I highlighted earlier, I think are relevant here. One is if you're going into weaker economic environments, you generally want to go up in credit, not down in credit. That's going to lead to IG credit being more in favor. Again, you want to make sure you're being paid for complexity, and you're being paid for liquidity, as opposed to being paid for that kind of directional credit risk, or really making investments in investments where if you're wrong about the scenario that you're underwriting to, the return that you're going to get, it could be vastly different. So investing in things like structural mezz, I'm surprised that that we haven't spent a second yet talking about SRT at all. But those types of investments where you're ceding control of the servicing or asset management of the asset class, but you're also structurally mezz, right? That's potentially a dangerous place to be if the economy is weakening. So prefer to go up in credit, prefer to try to get paid for the liquidity and the balance sheet that you're providing, and avoid levered or kind of binary type risk profiles.